Markets are closed. It is Saturday. And if you have been watching Market Crux for the past few weeks, you already know what that means. Weekends are not downtime here. Weekends are when the structure of the next week gets built. While most people switch off, the data does not. The vault reports still update. The geopolitical situation still moves. The physical flows keep draining. What I am going to cover in this video has several layers, and I will tell you right now, what comes later in this video may be the part that shifts how you see everything that came before it. So stay in. Every part of this builds on the next. Let us get into it. Silver closed at $84 in the West on Friday. Shanghai is pricing it at $96. That is a 14.6% premium of Eastern physical silver over Western paper. And this is not a one-day anomaly. Look at the sequence over recent sessions. 13.5%, then 13.8%, then 13.7%, then 14.5%, then 14%, and now 14.6%. That is not noise moving sideways. That is directional movement. The gap is widening, session by session, and it is telling you exactly where real, unlevered demand for physical metal is concentrated. Now here is the layer underneath that premium. And this is the part most people are completely missing. Professional buyers have been pulling physical silver out of COMEX every single trading day. Institutional hands taking delivery of real metal. Consistently, session after session, without stopping. And at the exact same time, the Sprott Physical Silver Trust is trading at a 5.7% discount. Western retail has not come back to silver, not even slightly. For anyone who understands market structure, that contrast is everything. In 2011, the Sprott Trust carried an average premium of 17.3% across the full year. Right now, we are sitting at nearly a 6% discount. That single data point tells you this move is not being driven by Western speculative sentiment. It has not been contaminated by the kind of retail froth that collapses fast. This is institutional accumulation, quiet, consistent, and deliberate. And here is why that matters for the return structure. When Western retail does eventually come back, and it always comes back when the price action becomes impossible to ignore, the shift from a 6% discount to a double-digit premium is a multiplier that operates completely independently of the silver price move itself. You get the price appreciation, and then on top of that, you get the premium expansion. The people who understand asset structure are already thinking about that spread. Most people are not. Now let us frame the geopolitical picture, because none of this silver data is moving in isolation. In our last video, we covered WTI posting its biggest weekly gain since 1983. The Strait of Hormuz functionally closed to Western-linked vessels. Over $900 billion wiped from U.S. equities in a single session. That was the setup going into this weekend. Here is what has developed since. Iran struck a multi-flag tanker near the Strait of Hormuz. The U.S. military is now preparing to deploy a third aircraft carrier to the Middle East. 1 carrier is a presence. 2 is a warning. 3 is a different operational posture entirely. Israeli forces completed extensive overnight strikes across Tehran and on military infrastructure at Mehrabad Airport. The U.S. struck a freshwater desalination facility on Qeshm Island. That last point matters beyond the headline. Moving from military targets to critical civilian life support infrastructure is a meaningful escalation in target type. These are different categories of warfare. A U.S. intelligence assessment concluded that even a large-scale military campaign is unlikely to fully remove the Iranian government. Read that carefully. That assessment coming from inside the U.S. intelligence apparatus means one thing precisely. There is no clean or near-term resolution being planned for. On the diplomatic side, do not be misled by the language coming out of Tehran. Statements from Iran's president suggesting attacks against neighboring countries may stop have been framed by some outlets as a peace signal. They are not. Look at the actual language carefully. Iran is not talking to the U.S. or to Israel. It is talking to its neighbors. That is a pressure move, designed to drive a wedge between Gulf states and the Western coalition. Not a genuine offer to stand down. The strikes are continuing. New targets are being considered. Trump simultaneously declared Iran beaten and threatened complete destruction. Those two statements cannot both be true at the same time. That contradiction does not resolve into stability. It signals a conflict still in motion. Oil. This weekend, Oman crude confirmed above $100 per barrel. Oman crude is the primary pricing reference for Middle Eastern oil flowing into Asia. When that benchmark moves, it matters. It is not yet above $100 across all benchmarks, but Oman leading is the signal to watch. That number historically does not stay isolated. The strait remains restricted, and now Qatar has declared force majeure on LNG exports. The Ras Laffan facility, one of the single largest LNG production complexes on the planet, has been shut down. Qatar supplies roughly 20% of global LNG, a month or more to return to normal output. This is not a price spike. This is a structural supply shock landing on a market already under severe stress. There is also a direct strategic statement worth noting. The head of the U.S. National Energy Dominance Council stated publicly that the U.S. ultimately will not need to worry about the Strait of Hormuz, because the goal is to get oil entirely out of the hands of those currently controlling it. That is not hedging language. That is an articulated strategic objective. And it implies the disruption timeline is not being measured in days. Europe is the most exposed casualty of everything we have just covered. Before Ukraine, Europe ran on cheap Russian pipeline gas. That is gone. They replaced it with expensive LNG. Now Russia is redirecting its remaining LNG flows to China and India, before the EU ban even takes full effect. Qatar is offline. The Hormuz corridor is restricted. Europe has no viable substitutes. Gas prices are already up over 50%. The US supplies more than half of Europe's LNG, which means Washington now holds the pricing lever for European industrial output. If this disruption runs for weeks rather than days, the conversation stops being about price spikes and starts being about factories that close and do not come back. This is the same trap that economists have studied in energy price shocks throughout history. When the root cause of inflation is supply disruption, not demand expansion, rate policy becomes almost useless. Raise rates into a supply shock, and you crash the economy without solving the price pressure. The Fed already faces that dilemma from the oil move we covered in the last video. This chapter makes it worse. There is a broader framework worth understanding here, one that has been circulating in serious macro circles for years and deserves honest examination rather than dismissal. The argument is this: wars near major energy choke points function as a form of global silent tax. When oil rises, the cost of transportation, agriculture, shipping, manufacturing, and logistics rises with it. That increase flows through to every consumer on Earth. Without a vote, without a parliamentary debate, without anyone signing off. Now here is the part that ties the whole architecture together. Oil is priced in dollars, which means every country on the planet that needs energy must first acquire dollars to buy it. That constant global demand for dollars is not an accident. Energy demand becomes dollar demand. The revenues generated concentrate among a relatively small group of producers, and a significant portion of that capital historically recycles back into U.S. government debt markets. So the pipeline looks like this. The world pays higher energy costs. Those costs are settled in dollars. The capital concentrates at the top of the supply chain, flows back into financial markets, and funds the structures that maintain the system. Whether you accept the full theory or not, the incentive structures it describes are not abstract. They are visible in the price data every single time a conflict flares near a choke point. Draw your own conclusions, but understand the mechanics. Now the China picture, because this adds another layer to everything we have been building. The People's Bank of China increased its gold holdings in February for the 16th consecutive month. 30,000 troy ounces added. Total holdings now at 74.22 million fine troy ounces. 16 months without a single break. That is not tactical hedging. That is a structural reallocation of national reserves, executed with full consistency and in complete public view. The World Gold Council noted that global central bank buying broadly slowed at the start of this year. Net buying totaled just 5 tons in January, against a 12-month average of 27 tons. China did not slow. China continued. Gold is now above $5,170 in Western markets. Eastern demand is not softening. Some central banks are selling. Poland's governor proposed liquidating reserves to fund defense spending, as we covered earlier this week. But buying is still outpacing selling across the board. and the concentration of buyers remains firmly in Central and East Asia. That geography connects directly to the Eastern silver premium, expanding session by session. These are not separate stories. They are the same story told in two markets simultaneously. Now, the development in silver that is getting almost zero coverage anywhere, and it may be the single most significant structural shift in this market in years. For the first time in literally decades, silver is no longer the #1 commodity by days to cover on the concentrated short position chart. Platinum has taken that position. Why? Because the big commercial traders in silver, the institutions that have functioned as the most reliable source of selling pressure in this market for years, have been aggressively covering their short positions over the past 6 months. Here is the breakdown that matters. The 4 largest traders still hold a significant short position, and it appears concentrated in just 2 US banks. But positions 5 through 8, the smaller commercial traders, now hold their smallest short positions on record. Read that carefully. The paper mechanism that contained silver price discovery for decades is losing its structural capacity. Not because someone flipped a switch, because the institutions that made it work are quietly walking away from it. The Commitment of Traders report is a public weekly document. The trend is there for anyone who pulls it up and looks. We are not asking you to take our word. Verify it yourself. The bear case is real, and we will always give it to you straight. Paper markets still dominate short-term price discovery. A ceasefire rumor, even an unconfirmed one, a DXY reversal, or a coordinated algorithmic flush can push silver lower fast. Regardless of how tight the physical market is underneath, the COMEX leverage ratio still sits near 7 paper ounces for every registered physical ounce available for delivery. That ratio can suppress the tape for longer than the fundamentals suggest it should. The gap between physical reality and paper pricing does not close in a straight line. It closes in an event. For long-term holders, the frame is different, and it should be. The structural deficit does not care about a bad week or a difficult month on the tape. The short covering trend is a multi-year signal, not a weekly one. And here is the context that sits underneath all of it. The world just hit its highest recorded level of uncertainty, surpassing the financial crisis, the dot-com collapse, and the pandemic. Real assets with finite supply have not lost in that environment over time. That is not an opinion. That is the historical record. For those tracking over the weekend, tokenized gold products like Pax Gold and Kinesis do not close when traditional markets do. Neither does IG spot pricing. These are not perfectly accurate benchmarks, but they are useful directional signals for where metals may open on Monday. Right now, they are trading close to Friday's closing levels. Nothing significant moving in either direction. Oil spot on IG has moved higher, but nothing prominent enough to call a new level yet. When it is, we will cover it. Here is what to watch going into Monday. Watch the Shanghai Silver Premium. Watch whether COMEX registered inventory holds or continues draining. Pull the Commitment of Traders report. It is public and updated weekly. The PBOC purchase figures came directly from the central bank. The COMEX inventory reports are updated every single day. Verify everything we have shown you. Do not take our word for it. That is the entire point of this channel. The data is public. The structural story is visible to anyone willing to look at it directly. The people who verify it themselves are the ones who do not get caught off guard when the event arrives. Invest with logic, not hype. Market Crux, signing off.